Welcome to The Explainer. So today we're unpacking a topic that touches, well, pretty much everyone's financial future, but it holds some deeply hidden secrets. We've all been taught, right, that the 401k is this ultimate silver bullet for retirement. You set it, you forget it, and decades later, you just sail off into the sunset. But what if I told you that the very system designed to protect your nest egg actually has some massive structural cracks? We're going to dive into the data, pull back the curtain, and show you exactly why a 401k alone might not be the complete solution you think it is.
Let's start things off with a pretty jarring number from recent research, 52%. That's the percentage of analyzed 401k plans that contain what financial experts call dominated funds. Now, these are toxic, high-cost investment options sitting right there on your menu. They offer absolutely zero unique diversification benefits, yet they charge you significantly higher fees than comparable funds. Basically, over half of all plans are setting a trap for unsophisticated investors. Crazy, right? Which really leads us to a deeply personal question. Is your 401k actually enough for a secure retirement? Look, if you've ever had this creeping, subconscious anxiety about outliving your savings, you are definitely not alone. A recent survey actually showed that 55% of adults are worried about exactly that. And as we're about to see, relying solely on an employer-sponsored plan leaves you wide open to longevity risk, market volatility, and hidden fees that act as, well, compounding in reverse.
So here's our roadmap for the Explainer today. We're going to cover 1. The 401k reality check. 2. Hidden fees and dominated funds. 3. Diversifying with an IRA. 4. The annuity income advantage. And 5. Your new retirement roadmap.
All right, let's jump right into Section 1, the 401k reality check.
Now, don't get me wrong, the 401k is an incredible tool, especially with those pre-tax contributions and employer matches, but it relies heavily on this massive assumption that you, the investor, are completely financially rational. And that brings us to a behavioral trap known as the one-to-end heuristic, or naive diversification. Think of it like a buffet. When faced with a menu of, say, 10 funds, a lot of people will just put 10% of their money into each one, figuring that makes a balanced portfolio. They spread their contributions equally, totally ignoring the actual quality of the funds. This means if an employer adds a terrible high-fee fund to the mix, participants are predictably going to lose money because they'll blindly invest in it just because it's sitting there on the menu.
We also need to acknowledge a huge, glaring gap in the system. Right now, there are 56 million American workers who don't even have access to a 401k or similar employer plan. No access at all. Whether you're part of that 56 million or you're just looking to bulletproof your current strategy, understanding how to build a retirement plan beyond the traditional workplace account is absolutely critical.
And that brings us to Section 2, hidden fees and dominated funds.
So, under the guise of offering you a large menu of choices, courts will often shield employers from liability, as long as they offer at least a few good options. But this legal loophole lets them clutter the rest of the menu with those dominated funds we just talked about. These are objectively poor investment choices right from day one. They offer no unique diversification, but they charge at least 50 basis points more than comparable funds. So the big question is, why are they even there? Well, a lot of times it comes down to revenue-sharing conflicts. Basically, fund managers kick back fees to cover the plan's administrative costs. The end result? Everyday investors who accidentally pick these funds end up subsidizing the administrative expenses for everyone else. It's wild.
Now check out the stark difference in cost drag here. Research from the Yale Law Journal shows that in an average plan, fees and menu restrictions lead to a cost that is 78 basis points higher than standard retail index funds. And mathematically speaking, the absolute optimal portfolio weight for a dominated fund is less than 1%, basically zero. Yet, because of that naive diversification behavioral trap, these toxic funds actually hold over 11% of plan assets where they're offered. People are buying them without realizing what they are.
As that Yale Law Journal analysis so brilliantly puts it, excessive fees act as compounding in reverse. Just think about that for a second. You are working hard, saving early to harness the power of compound growth, but these high fees are silently eating away at those gains year after year. In fact, the data shows that in 16% of analyzed plans, the fees are so outrageously high that they literally consume the entire tax benefit of the 401k for young employees. I mean, that completely defeats the purpose.
And hey, if you think paying those higher fees guarantees better performance, think again. The data completely proves that chasing expensive, actively managed funds usually just results in predictable underperformance. Roughly 85% of U.S. large-cap active funds actually lag behind the S&P 500 index over a 10-year period.
So you're paying a premium for someone to manage your money, only for them to do worse than a totally unexciting basic index fund. You're basically paying a premium for participation trophy.
Which brings us to our first major solution in Section 3, diversifying with an IRA.
Okay, so one of the biggest reasons you need an IRA is to dodge what financial planners call the age 73 tax trap. If you just blindly hoard all your money in a pre-tax 401k, the IRS eventually forces you to take required minimum distributions, or RMDs, once you hit 73. For high earners, these forced withdrawals can unexpectedly push your income up so high that it triggers taxation on your Social Security benefits, plus massive Medicare IRMA surcharges. It can effectively jack your marginal tax rate up to near 40%. It is a massive hidden trap waiting for you in retirement. So, how do we fix this? We leverage a clear tax fork in the road, the traditional versus the Roth IRA. A traditional IRA is a lot like your 401k. It grows pre-tax and you pay the tax man when you withdraw. But a Roth IRA, that is funded with after-tax dollars. The absolute magic of the Roth is that your withdrawals in retirement are entirely tax-free. And crucially, there are zero required minimum distributions during your lifetime. By shifting some of your savings into a Roth, you can completely bypass that age 73 tax trap.
Let's empower you with some current facts. For 2026, the standard IRA contribution limit is $7,000, and there's an $8,000 catch-up limit if you're 50 or older. But here is an incredibly powerful, lesser-known strategy you've got to know about: in-service rollovers. If your employer's plan is designated as a high-cost plan, just stuffed with those toxic dominated funds, you might actually have the right to roll over your assets into an IRA while you are still employed. It's literally a get-out-of-jail-free card for your nest egg.
All right, let's move on to Section 4, the annuity income advantage.
Let's look at the stark reality between these two vehicles. A 401k or an IRA is at the end of the day just a pile of money. It's totally exposed to market volatility, it offers absolutely no guaranteed income, and when the pile runs out, well, it's gone. An annuity, on the other hand, isn't an investment in the traditional sense. It's an insurance contract. Specifically, a fixed-indexed annuity provides principal protection against market crashes, all while generating a guaranteed stream of income for the rest of your life. It's absolute insurance against outliving your savings.
So if you've got an old non-contributing 401k from a previous job, rolling it into a fixed-indexed annuity can unlock some massive benefits. You keep your tax deferral, right? But you also gain growth potential that's tied to a market index. This means you capture the upside, but your principal is entirely protected from downturns. Even if the market drops to literal zero, you never lose your principal. Plus, with optional riders, you can secure guaranteed lifetime withdrawals and even tack on inflation protection or a death benefit for your loved ones. It's a real game changer.
And finally, we arrive at Section 5, your new retirement roadmap.
To build a truly holistic strategy, we've got to do a little bit of housekeeping. Are you, by chance, one of the 1 in 5 U.S. workers with a forgotten or abandoned retirement account from an old job? If you are, that money is just sitting there inactive, completely at the mercy of whatever fee structure your old employer picked, and it's highly likely losing its real value to inflation. Tracking down and rolling over those old accounts is step number 1 to taking back control of your financial future.
Next up, you need a serious reality check on your planning assumptions. Stop planning for a guaranteed 7% annual return. You've got to stress test your portfolio with lower expectations to account for wild market volatility, and you have to account for healthcare. The data shows healthcare costs jump 50% or more after age 55. But paradoxically, you still need to keep a healthy allocation of stocks in your portfolio even as you age, simply to outpace inflation. So the crucial takeaway here is that your plan is never set it and forget it. You've got to adjust it because life changes.
Okay, let's dive into the literal roadmap of actionable steps you need to take to shatter this myth of the 401k silver bullet. Step 1. Absolutely maximize your 401k employer match. Never ever leave free money on the table. Step 2. Don't stop there. Diversify your tax strategies by routing extra funds into a traditional or Roth IRA so you can actually control your tax bracket in retirement. Step 3. Secure your baseline living expenses with guaranteed lifetime income from an annuity. And Step 4. Review and rebalance your entire portfolio annually.
Look, the 401k is a totally foundational piece of the puzzle, but it is not the entire picture. Between excessive fees, dominated funds, sneaky tax traps, and the sheer risk of living too long, relying on it alone is a really dangerous game.
By adding IRAs for stability and tax control and annuities for guaranteed income, you can literally build a fortress around your future. So I'll leave you with this one final provocative question to chew on today. With your current strategy, will your money last as long as you do? Thanks so much for joining me on this explainer, and I highly encourage you to go review your retirement roadmap today.